Welcome to the Consumer Economics Credit Unit. Credit can be a valuable tool. Like many privileges, it comes with responsibilities. With discipline and wise decision making, credit can be a strong personal asset. Credit is the supplying of money, goods, or services at present in exchange for the promise of future payment. When you borrow money from a bank or use a credit card to purchase gas, you're using credit. The business or organization that extends the credit is the creditor. Each party in any credit transaction trusts the other to carry out his or her part of the agreement. For example, a bank, which in this example is the creditor, might loan you $5,000 to purchase a used car. The creditor agrees to accept monthly repayments over a period of 3 years. The borrower agrees to repay a total of $5,700. That includes $5,000 of the principal, or the original borrowing amount, plus the $700 in interest paid with the creditor's money. In this example, credit benefits everyone involved. The borrower was able to purchase the car, the seller found a willing buyer, and the bank profits by receiving interest income over time. The credit available to consumers ranges from credit cards to bank loans to merchant finance contracts. In general, consumer credit can be categorized in the following ways. First, cash and credit card sales. If you take out a loan and receive cash, you're using cash credit. If you buy something now and wish to pay for it later, you're using sales credit. The other one is secured and unsecured credit. Secured credit is backed by a pledge of property. In other words, the borrower offers something of value as assurance that the loan will be repaid. The lender has a security interest in the pledged property, meaning that the property can be taken by the lender if the loan is not repaid. The property that is pledged to guarantee repayment is known as security or collateral. Because collateral reduces the lender's risk, secured credit is generally easier to obtain than unsecured credit. In the example shown below, you can see that a car and a house are examples of secured credit, while student loans and credit cards are examples of unsecured credit. Closed-ended credit is a one-time extension of credit for a specific amount and time period. The total amount of interest to be paid is known at the beginning of the loan. Closed-ended credit is typical when you are either buying a car or buying a home. The reason for these is you typically don't have the full amount of funds available to purchase these items in one lump sum. Therefore, you have to take a loan out from a bank. In this case, you pay monthly installments for the car, typically anywhere from 3 to 5 years. For a home, you typically would take out a loan for anywhere from 15 to 30 years for that mortgage. In contrast, open-ended credit, sometimes referred to as a line of credit, can be used repeatedly. A typical credit card provides open-ended credit. The cardholder makes a monthly payment of all or part of the account balance. The amount of interest that must be paid is based on the account balance at any given time. You can also see down at the bottom that there are actually two types of credit cards. The first is a general purpose credit card, most typically seen possibly in your wallet or your parents', which is Visa, MasterCard, Discover, etc. Private label cards are typically lent out at stores. The examples that we have here are Kohl's and Target. Many other stores offer these as incentives or as one-time percentages off your purchase at that time, while also making them the creditor. Credit is a privilege that benefits consumers in several ways. Its advantages include the temporary expansion of income, as seen here. Credit allows you to use goods and services before you've paid for them or while you're paying for them. This is especially helpful for unexpected expenses that can't wait, such as replacing a worn-out refrigerator. Major purchases such as a car or home might not be possible without credit. The second one you can see down there is convenience. Credit cards give you the secure feeling of being able to make purchases without carrying a large amount of cash. You can also shop online or by phone with a credit card. Getting a refund on returned items is usually easier if they were charged, and monthly statements of credit card purchases simplify record keeping. Having a credit card also provides you financial responsibility. Good credit provides proof to others of your financial responsibility and can further make it easier for you to obtain credit in the future. Like everything in life, there are advantages and there are also disadvantages. The first one that you can see on there is interest and fees. The cost of using credit, including interest and any fees, is called the finance charge. Finance charges can usually be avoided if a credit card is paid in full each month. Every consumer should try their hardest to try and pay their credit card at the end of each month. There's also the increased cost of merchandise. Retailers who offer credit cards have to pay banks to collect on their credit sales and be prepared to write off unpaid debt. To offset these costs, many businesses actually increase their prices for goods and services. Some offer a discount for you to pay cash. There's also opportunity cost. Although credit provides expansion of income at first, in the long run it reduces purchasing power. Repaying borrowed money plus interest forces consumers to give up things that they want or need now and in the future. The wants and needs they give up are the opportunity cost of credit. Something new that's come up in the last 10 to 15 years while using credit is also the possibility of identity theft. Using a credit card requires that you take precautions against the card being stolen or otherwise used without your permission. One of the most important disadvantages of credit is impulse buying. The power of credit can make you more likely to buy items on the spur of the moment without careful consideration that a purchasing decision deserves. A lot of times just swiping that card is much easier than pulling out cash that you may or may not have. Along with impulse buying, there's overspending. Handling a credit card instead of real money can make items seem almost free. However, the debt that mounts up is very, very real. Consumers who consistently spend more than they can afford get into financial trouble that may take them years to undo. Another disadvantage is actually just reclaimed merchandise. If you buy on credit and fail to pay for those items in full, they could take them back. This is called repossession. The bank could actually repossess if it's a car and you're not making a payment, they can come take that car. Same thing with a home. If you don't pay your mortgage, you can get foreclosed on and actually be kicked out of your house because the bank is actually the true owner until you pay off that debt. In this slide you can see there's two columns. When should you use credit? When shouldn't you use credit? You should use credit for major purchases. Large items, large ticket items that you may not have the cash on hand that you would actually need to borrow money from a creditor. Another one that's important is when you're making reservations. Whenever you're going on vacation, you want to rent a car, hotel, sometimes they require a credit card in order for you to purchase this. Many times the company may not just take your word and say, yes, I will show up, or yes, I will be at the hotel at this date. The credit card basically confirms your agreement to show. Also for emergencies. If you're driving home from college one day and you get a flat tire and you don't have cash in your wallet and the tow truck driver comes and demands $200, if you have a credit card, that would actually be very helpful for you. He would accept that. It also benefits your future. As you move on, post high school, and you decide to attend a trade school or college or whatever it might be, most students will take out loans. With the cost of college rising, this is very important. On the right-hand side, you can just see a couple that we are talking about, mainly being impulse purchases. In my opinion, that is the most difficult thing for high school age students and college students and even young adults. Having that credit card is so much easier just to walk up to the counter and swipe. It's very difficult for you to know how much you may have or have not in your bank account, but you just swipe the credit card and hope to make the payment at the end of the month. You also shouldn't do it for everyday purchases. Sometimes just having cash on hand may be a better alternative. If you're going to the grocery store, it makes it easier for you to budget if you bring $50 in cash rather than spending $200 on things that you may or may not need. Also, another easy way when you shouldn't use credit is on websites that you may or may not trust. Before they will extend credit, banks and other lenders want to know how much of a risk they're taking. Is the borrower likely to pay back the money on time? Since the lenders don't have a crystal ball to see into the future, they focus on the borrower's present and past. In this slide, you'll see that there are three columns: character, capital, and capacity. In deciding whether to extend credit, lenders consider these three C's. Character refers to a person's reputation, especially concerning repayment of debt on time. Capital refers to the items owned, anything that you have, savings, any investments you may have, etc. Capacity is a person's earning power and ability to pay debts from their regular income. Creditors are going to want to know, how much do you make a year? Is it a salary? Is it a wage job? This will help determine how much credit would be available to you. The main way in which a consumer can demonstrate the first C, or character, is by establishing a positive credit history, or pattern of past behavior in regard to repaying debt. Without a credit history, lenders have little information in which to evaluate the consumer's reliability. On the other hand, if the potential borrower has a record of paying past debts in full and on time, the lenders feel more confident in extending credit. As you go out into the world, you're obviously going to be applying for credit. A couple things to consider before you're applying for credit is your employment. Where are you working at currently? Do you own a home? What are the costs associated with that house? Do you have a credit history, and if so, is it good? What collateral or things do you actually own outright that you could use as backing for this loan that you may be looking to take out? Also, creditors will be looking for bank references. Most creditors will be looking for, have you stayed at the same banking institution for a long period of time? A credit bureau or credit reporting agency is a firm that collects information about the credit worthiness of consumers. Credit bureaus get their information from stores, banks, and other creditors, as well as from public records such as court judgments. In addition to local credit bureaus, there are 3 national credit reporting agencies: Equifax, Experian, and TransUnion. Credit bureaus and reporting agencies compile the information into a credit report, basically a record of your consumer's transactions and payment patterns. The report is then sold to creditors who are evaluating applicants. A credit report includes information such as the date each credit account was opened, the balance owed, the monthly payment amount, and whether payments have been late. If you take a look at this picture, this breaks down how your credit score is actually put together. 10% of which is for what type of credit do you use: open-ended, secured, unsecured, etc. The frequency of new credit is also looking for how often are you actually opening up credit cards or applying for different types of loans. Another portion that you see here is the length of the credit card history. If you're a young student, 22 years old, that just graduated from college and applying for your first credit card, you probably do not have any credit history at all. You can see that this takes up a large portion, about 15%. So you want to establish credit as early as you possibly can. If you look over to the bottom right portion of the graph, you'll see right here, amounts owed relative to limits. Essentially what this is looking at is your capacity. How much credit or debt do you have in relation to your income? You can see that this is the second largest percentage that they actually take place when it comes to your credit score. Finally, you'll see the last and largest percentage when it comes to creating your credit score. 35% of which is made up of your payment history. That is essentially saying, are you paying your debts on time? If you have a mortgage, are you paying every month? If you have a car, are you paying that installment every single month? Have you missed 2 or 3 months in a row and then you have back pay that you may need to do? That would negatively affect your score, and it takes up by far the largest percentage. On this slide, you'll see a picture. What it's saying here is, what is a good credit score? If you look on the left, you'll see the low end. The lowest possible score you can actually have is a 300. While as we move down, you can see that the largest and highest number that when it comes to credit is an 850 credit score. Now you can see here that anybody who has a range of 300 to 550 would be considered poor credit. It's going to be very difficult for that person to obtain a loan. As you look at the higher ends, 740 to 850, you can see that the mortgage rates that person would qualify are much lower. Also, if they were to buy a car, the interest rate that they would have to pay on the car is much lower than somebody who had poor credit. In a nutshell, you would much rather be at the top end with that excellent credit so that you can get better rates, rather than at the low end and have poor credit where you're actually paying more if you can even possibly obtain a loan. When talking about credit reports, it's also important to understand that negative information can actually stay on your report for up to 7 years. Bankruptcy, which is possibly the worst thing that could happen to you if you couldn't pay back any of the lenders, actually stays on your report for 10 years. When buying credit cards, there's 2 different things that you need to be aware of. First is the annual fee. Essentially what that is the amount that you pay per year just to have the credit card. For example, I have an American Airlines credit card. What I do is for every dollar that I spend, I actually get 1 mile if I were to choose to fly. I have to pay a fee of $75 a year just to keep that credit card. Another important factor is annual percentage rate, or APR. It's the annual rate of interest that is charged for using credit. The APR of revolving credit cards can vary significantly and make a very big difference in the cost of using credit. You must make at least a minimum payment by the due date. The credit agreement will state how the minimum payment is determined. It will also state what happens if you fail to make a required monthly payment when it's due. For example, the creditor may require payment in full for the entire amount of the outstanding balance if you were to miss a minimum payment. Many credit cards allow a grace period, or a period of time during which the balance may be paid in full to avoid finance charges. A grace period of 20 to 25 days is pretty much common. Check the terms carefully to see how the grace period works. For instance, it might not apply if there's an unpaid balance carried over from a previous bill. The credit limits the maximum amount of credit that a creditor will extend to the borrower, essentially you, the consumer. If the credit limit's $1,000, your unpaid charges cannot total more than the amount at any time. There's a variety of fees associated with credit cards, such as late fees, cash advance fees, exceeding your credit limit. The list goes on and on. You want to check with your credit card company before you actually sign on the dotted line to obtain that credit card. One of the newer trends in credit cards are actually offering consumers rewards or benefits for using that card. The example that I stated earlier about my American Airlines credit card where I get 1 mile for every dollar that I spend, a lot of banks are also giving incentives such as cash back. I know that there are some at Sam's Club and Costco where they'll actually give you 3% back if you use their credit card on gas purchases. There's a variety of them, and you also, again, want to check in with those with your credit card company before signing on that dotted line. I cannot stress enough how important it is to use credit wisely. Here's a list of a couple things, and I'll just talk about a couple of them very briefly. But don't take on any more debt than you can handle. Make a budget, stick to it. Use a credit card like it was talked about before, for emergency situations. Anything that you may need. Some people, as long as you're a balance payer and you're paying off at the end of every single month, you'll be fine. Another important thing that many consumers don't do is they don't check their credit report every year. You should do this. It's free. It's by far one of the most important indicators. It's just like an ACT or SAT score, but it sticks with you for life. Another thing I would recommend is managing your credit by paying your bills on time. As I just talked about, the term called balance payer is someone who pays off their credit card bill at the end of every month. After that 20 to 25 day grace period, they pay their bills, they move on to the next month, and they continue using their credit wisely. Read those policy agreements that you get when you get a credit card. They're very important. They might be long, but I would say take the time to go ahead and read those. Okay? Make sure that you're looking at your statement. You'd be surprised how many consumers would say that they actually don't even look at their credit card statement at the end of every month. Check your receipts. Make sure they match up with them. There have been cases where credit card fraudulent where they would charge just $1 a month to see if people are actually checking their statements, and if they're not, then they might up it from $1 a month to $20 a month, where you're paying for things that you may not have actually purchased. There are many people who use credit cards for the rewards. Businessmen, women, use those credit cards while they're traveling to accumulate points, miles, cash back, whatever it might be. Again, last but not least, pay off that balance. If you can't pay the whole balance, pay as much as possible. Do not stick to just paying the minimum. Alright, here's the bad stuff. Debt collections. You've probably seen on TV those repo men, things like that. Essentially what they'll do is if you don't pay off your car or whatever you've taken, a boat if that's the case, they will come after you and they will take possession of whatever item that you think is yours from you. If you don't pay your bills, they do have the legal right to take possession of those items. They can also shut off your gas, your water, your electricity if that's the case, if you're not paying your bills. There are collection agencies that businesses will go to. Well, they will then try and hunt you down through phone calls. They could possibly ring your doorbell if that's the case. Very important. There's also legal aspects to debt collections. There's things called a lien, which is a claim upon property to satisfy a debt. If you have somebody that does a roof on your house, and you don't pay them, they could put a lien on your house until they get payment for that service. Wage garnishment would also be very bad. Essentially what that is the government will take money out of your paycheck. Wherever you're working at that time, it will be taken out in order to be repaid to collectors. Another important thing to credit is co-signing. It's signing a legal document in order to guarantee a loan or other obligation. So the example you can see below is your friend Jeff asks you to co-sign a loan on an automobile. You agree and sign all the paperwork involved. 6 months later, Jeff can't afford to make his payments. You are now legally responsible to make those payments. I would highly recommend not co-signing a loan with a friend or anything like that, possibly a family member. I have had friends and I know people who have had parents that may co-sign on a first car for a teenager or a young adult. In those situations, that's fine. But if a friend that you don't know that well asks you to co-sign on a loan, I would not recommend doing that. And here it is, our last slide, and as you can see up top, the last resort, bankruptcy. Essentially what that is you have gone through all the different channels of trying to pay back your lenders, but you just can't do it anymore. It's legal relief from certain amounts of debt. The two that we have highlighted here is Chapter 7, which is essentially what you would call straight bankruptcy. It wipes out debt, but the assets are sold to pay the creditors. So essentially, all of the assets that you may have inside of your home are going to be sold to the highest bidder. You don't receive that money, the money then goes to the creditors. One that's a little bit different is Chapter 13. Chapter 13 is more of a restructuring. You can keep your property, but it creates a court-approved and supervised plan for you to pay back those creditors. Securing debt is incredibly difficult for those 10 years that you are after you file for bankruptcy.